This lecture is on cash flows. We're going to look at the difference between financial cash flows and accounting cash flows. I'm your professor, Dr. Stephen Haggard. Here's a very basic idea. The assets of the firm create cash flows. Where did we get the money to purchase those assets? From the investors, the bondholders, and the shareholders. So in essence, the cash flows produced by the assets should flow to the bondholders and the shareholders. That's what this top equation really says. Cash flow from assets is equal to the cash flow to creditors, which is CF parenthesis B, meaning bondholder, plus the cash flow to the shareholders. Now, the cash flow to creditors is calculated as interest minus the change in long-term debt over the period. Now notice it's long-term debt. Sometimes students get confused and think this should be total debt, but that is not the case. Some of you will disagree as to whether this should be total debt or long-term debt. And so I have posted a proof of why cash flow to creditors is equal to interest minus the change in long-term debt on the Blackboard site. Next we have the cash flow to shareholders, and we have dividends minus, parentheses, stock sold minus stock repurchased, close parentheses. Now, dividends is a way that the firm is able to send cash back to the shareholders, the same way that interest is a way to send cash back to the creditors. And in the same way that an increase in long-term debt is actually a cash flow from creditors, an increase in common stock is actually a cash flow from shareholders. That's why we subtract these things out in these two formulas. Let's work through these calculations using the numbers from our sample balance sheet and income statement. Here we have the formula for cash flow to creditors, and we get the interest from the income statement. It's 49. And we get the ending long-term debt and beginning long-term debt from the balance sheet. In this case, the ending long-term debt is 471 and the beginning long-term debt is 458. What that means is debt went up, long-term debt went up by 13 over the period. An increase in debt would be a cash flow from creditors. And so that's why this has a minus sign in front of it, this change. So we wind up with 49 minus 13 being equal to 36. So our cash flow to creditors is 36. Next we're going to look at the cash flow to shareholders. Dividends represent a cash flow to shareholders in the same way that interest represents a cash flow to creditors. Then we subtract out the net new stock sold. And that's stock sold minus stock repurchased. What we need to do is look at how much stock was issued during the period and then subtract the amount of stock that was repurchased during the period. This is similar to our change in long-term debt from above, but it's a little more difficult to calculate because we have to look at both common stock and capital surplus to determine how much stock was sold, and then we have to look at treasury stock to figure out how much stock was bought back. In this case, we can look at, first of all, the dividends. Where does it come from? The income statement. We can look down toward the bottom of the income statement and see that dividends were 43. Now we need to figure out how much new common stock was issued. Now we discussed earlier in the balance sheet that you have to add together both the common stock and capital surplus accounts to figure out the total amount of common stock that's been issued to date in dollars. And so for the latter period, that's 347 plus 55. And for the prior period, it's 327 plus 32. And so when I do the subtraction there, it's going to give me 43. And then I need to subtract out the increase in the treasury stock. Why? Because the treasury stock represents stock that has been repurchased. And that account increased from 20 to 26 between our two periods. And so that means that over the year, the firm repurchased an additional $6 million worth of stock. And so my calculation becomes 43 minus, open parenthesis, 43 minus 6, close parenthesis, or 43 minus 37, which gives us 6. And we know that the cash flow from assets has to be equal to the cash flow to creditors plus the cash flow to shareholders. So we merely add 36 and 6 together and get 42. Just in case you're still a little confused, let's go over exactly where those numbers came from that we just worked with. First of all, we were figuring cash flow to creditors, and the first cash flow was interest expense. And that's right there in the middle of the income statement, right above pre-tax income. We also were interested in the increase in long-term debt. And if you'll notice, it goes from 458 to 471 on the balance sheet. That's on the right-hand side of the balance sheet under long-term liabilities. So that's an increase of 13 in long-term debt. So that will offset that 49 that we paid out to the creditors because this is an additional 13 we borrowed from the creditors. So that gives us 49 minus 13, gives us our 36 cash flow to creditors. Cash flow to stockholders starts with dividends, and you'll find the amount of dividends that we paid out at the bottom of the income statement. There it is, 43. But we also need to know how much new stock was issued and how much stock was bought back. To find out how much new stock was issued, we need to look at the common stock amounts for the final year and the prior year. In this case, in the final year, we know that the common stock is a combination of the common stock at par and capital surplus accounts. So 55 plus 347 gives us 402. And in the prior year, if you add those two accounts together, you will see they were 359. So 402 minus 359 is 43. That's 43 in new stock issued. But we also have to account for any stock that was repurchased. Look down further on the balance sheet toward less treasury stock. Anything that winds up in treasury stock is there as a result of a share repurchase. And so the difference between these two numbers, 6, represents $6 additional million worth of shares that were repurchased. And so we've got 43 million coming in from new stock issues and 6 million going out from repurchase of shares. And so the net new stock issued would be 43 minus 6, or 37. So now we have our cash flow to shareholders being the 43 dividends minus that 37 of net new stock issued. Now we just got through talking about where the cash flow from assets need to go, the bondholders and the shareholders. But we also need to know where that cash flow from assets came from. And so now we're going to show you another way to come up with CFA. In this way we see where that money comes from. First of all, let's talk about net capital spending. This is money that the firm has spent to acquire new assets minus what it received from selling old assets. And we go about this in a roundabout way. What we're going to do is take the ending net fixed assets and subtract out the beginning net fixed assets. Now, there's one problem here. That ending net fixed assets has been lowered by the amount of depreciation compared to beginning net fixed assets and the actual net capital spending. So we're going to have to add that back. So net capital spending is equal to ending net fixed assets minus beginning net fixed assets plus depreciation. From the balance sheet, we can see that ending net fixed assets is 1,118 and the beginning net fixed assets is 1,035. We have to add back 90 in depreciation. That came from the income statement. And when we work that math out, we get 173 net capital spending. Now, another area that requires investment is change in net working capital. Anytime we increase our net working capital, that actually consumes cash. If we decrease net working capital, that actually produces cash. Think about it this way. Net working capital is current assets minus current liabilities. Think about a current asset, let's say inventory. In order to increase your inventory, what do you have to do? Well, you have to buy stuff to put into inventory. That's a consumption of cash. And so we see when asset accounts increase, that consumes cash. And when liability accounts increase, that increases cash. Why? When you borrow money from a friend, that increases your liabilities. But what does it also do to the cash in your pocket? It increases it. And so what we see here is net working capital is current assets minus current liabilities. And therefore, increasing net working capital is going to consume cash. And decreasing net working capital is going to produce cash. Now, how do we figure out ending net working capital? Well, that's simple. We just take ending current assets minus ending current liabilities. And how do we find beginning net working capital? We take beginning current assets and subtract beginning current liabilities. And once we do that, we get all this math out of the way, we can see that net working capital has gone up by 23 over the year 2010. Next we have operating cash flow. These are the cash flows that are actually produced by our business, the actual part of the business where we're creating value for customers. And we find this operating cash flow by taking EBIT, or EBIT, however you want to say it, which is earnings before interest and taxes, and we're going to add back depreciation. Why? Depreciation is missing from EBIT, and it's not a real cash flow, so we're going to have to add that back. But taxes are a real cash flow, so we're going to have to subtract them out. Remember, EBIT is before interest and taxes, so we're going to have to subtract those taxes out. If we go to our income statement, we can see that EBIT is 219. We're going to add 90 in depreciation, that also came from the income statement. And we're going to subtract 71 in taxes. Now notice that is only the current portion of taxes. Why did we not also subtract out the deferred portion? Because it doesn't represent a real cash flow. When we do all that math, we come out with 238 for operating cash flow. And finally, we can bring all of these things together. Cash flow from assets is equal to operating cash flow minus net capital spending minus the change in net working capital. We said that OCF was 238, net capital spending was 173, and the change in net working capital was 23. And when we do that math, we come out with 42. Now this is exactly the same cash flow from assets that we obtained when we took cash flow to creditors and added cash flow to shareholders. That's not a coincidence. That's the way it has to be if your financial statements have been done correctly. Now let's talk about the accounting statement of cash flow. This is the third of the major financial statements that you will find in an annual report for a corporation. Accountants realize that the income statement does not actually represent cash flow, so they fix this problem. They fix this problem through producing a statement of cash flows. And in the statement of cash flows, there are three sections: operations, investing activities, and financing activities. Now this is an area where we have a major difference between finance and accounting. In accounting, interest expense is actually considered part of operations, but finance, we think that interest should be considered a cost of financing, when in fact it is. When we borrow money, we have to pay interest. That's a cost of financing. Typically, the statements of cash flow use net income as a starting point, and then they make adjustments for non-cash items. That's called an indirect method of coming up with an accounting statement of cash flows. There's also a direct method, where you start with sales and then subtract out expenses. But most of the annual reports that you read for companies are going to be put together in the indirect method, so that's the method that I'm going to teach you here.
Now it's time to see how all these things fit together. Let's start with looking at our statement of cash flows. And our statement of cash flows always starts with net income when we're using the indirect method for developing a statement of cash flows. So we start with net income, and then we have to make adjustments. Why do we have to make adjustments? Because net income is not cash. For example, net income has depreciation subtracted out of it, and we know that that is a non-cash expense, so we have to add that back. Thus, we add back 90 in depreciation. And the same is true for deferred taxes. That's not real cash, so we have to add it back, and it has been subtracted out of net income. Now, the next part gets a little trickier, and that is looking at the cash impacts of the changes in our current assets and liabilities. Anytime you increase a current asset other than cash, it decreases cash. For example, if I go out and buy $11 million worth of inventory to put on the shelf, that's going to consume $11 million in cash. However, if I am to sell $5 million of inventory, that's going to produce $5 million in cash. And so that's why we're going to look at these changes in current assets and liabilities. Now, liabilities work just the opposite direction. If a liability goes up, that actually produces cash. And if a liability goes down, it consumes cash. For example, if you loan a friend $100, that friend's liabilities go up by $100, but the cash in their pocket also goes up by $100. When that friend pays you back, their liabilities go down by $100, but so does the cash in their pocket. And so with liabilities, the cash and the liabilities go in the same direction. With assets, the cash and the assets go in the opposite direction. And so let's take a look here. Our statement of cash flow says that accounts receivable has consumed $24 million in cash. Now, accounts receivable is an asset account, and we said when asset accounts go up, they consume cash. And we can see here that accounts receivable went from $270 to $294, and thus consumed $24 million in cash. Inventories must have gone down. Why? I can see from the statement of cash flows that inventory activity produced $11 million in cash, so our inventory must have fallen by $11 million. Let's take a look. It went from $280 down to $269, and so that is consistent with what we've said so far. Now, accounts payable is a current liability, and we know that liabilities and cash go in the same direction. And so we see accounts payable here has produced $31 million in cash. That means accounts payable must have gone up by $31 million. And if we look at the balance sheet, we can see that accounts payable went from $455 to $486, an increase of 31. So that all checks out. Now we can add all these things together, and that gives us our total cash flow from operations. I want you to notice that this definition of total cash flow from operations has interest subtracted out. This is one of the differences between accounting and finance. In finance, we more correctly think of interest as part of the financing activities, and we would show that down at the bottom. But accountants treat it like it's a cost from operation. And so you say, wait a minute, I don't see interest anywhere here. It's hidden inside net income. It's already been subtracted out, and we didn't add it back, so apparently the impact of interest is still in the accounting total cash flow from operations. Now let's look at investing activities. We see that we've got acquisition of fixed assets of negative $198 and sales of fixed assets $25. What does that mean? It means we went out and spent $198 million on new stuff, and we were able to sell some of our old stuff for $25 million. And that gives us a net difference of $173 to the negative. Now, if you go back and look at your net capital spending, that's exactly the number we came up with for that. Now, where did that information come from about acquisition and sales of fixed assets? If you look at the footnote to the balance sheet, you'll be able to see where that number came from. Okay, let's take a look at financing activities now. We see we've got retirement of long-term debt and the proceeds from long-term debt sales. So when you retire debt, you're paying it off. That consumes cash. And when you're issuing new debt, that produces cash, and the retirement of long-term debt would lower liability, and the issue of new long-term debt would increase the liability. So what we need to do here is see what is the net effect. And I'm saying that negative 73 plus 86 is positive 13. In other words, our long-term debt on the balance sheet should have gone up by 13. And it did. It went from 458 to 471. Now let's look at dividends. Dividends are a real use of cash. When you pay dividends to the shareholders, that is a use of cash. And we paid $43 million in dividends, so that says minus 43 to reflect that cash outflow from the firm. We also repurchased $6 million in stock, and so that consumed $6 million worth of cash. How do we know we repurchased $6 million worth of stock? Look at the less treasury stock line on the balance sheet. It went from 20 to 26. 26 minus 20 is 6. That means there was an additional $6 million worth of stock that was repurchased. And finally we have the proceeds from a new stock issue of 43. How do we know that number? Well, we can look at our shareholders' equity. Notice preferred stock has stayed the same, so nothing's changed there. But our common stock has gone up by 23. That's 55 minus 32. And our capital surplus has gone up by 20. Remember, you have to add those two together to come up with your total stock issued. And when I do that, I get 43. And when I issue new stock, that is a source of cash. And so our cash goes up by 43. Now we can calculate our total cash flow from financing activities. We just add all those numbers together and we come up with positive 7. Now we have these three numbers that talk about cash flows in different areas of the firm. We can add those together to figure out what is the total change in cash. 207 minus 173 plus 7 gives us 41. So 41 should be the same as the change in cash between 2013 and 2014. And sure enough, it went from 157 up to 198, which is a change of positive 41.